Thank you very much. It's really a pleasure to be here today, and in particular a pleasure to organize a conference with Olivia. As you might know or respect, she's incredible in organizing this conference. She's incredible. For example, she asks people to submit paper a month in advance, and people do it. Which is really remarkable. And not only, but she's, one of the things I really love about this conference is that she's able to bring together, first of all, not just some of the best speakers and authors on this topic, but this great group of the private sector, the financial industry, the pension industry, policymakers and regulators, and academics. And I think I've always gone away from this conference learning enormously. We are very happy today to talk about debt in an aging economy. You know, a lot of the topics and a lot of the conferences here, in particular the PRC, have been looking at the asset side of the balance sheet. So savings and asset accumulations and so on. And often we have talked about net wealth, but we haven't focused a lot to the liability side of the balance sheet. And it seems that a lot has been going on that side of the balance sheet. As Olivia and I start looking at this topic, actually several years ago, we wrote, I think, our first paper documenting this increase in debt across these different cohorts as back as 2003. And one of the things we quickly discovered is that this was really a difficult topic to understand, rationalize, and explain well. And I think to really explain it, first of all, you have to look at it and put it in a perspective of an aging economy. So like population is aging, and what's happening as population age. You have to put it in a perspective this is 10 years or more after a financial crisis, so which also was originated by debt. So we need to explain that. We need to explain it in the context, for example, of macro variables, very low interest rate, but also changes in regulation. For example, the bankruptcy law of 2005. So there is so much going on and so much to explain, and this is why I'm so excited to be chairing this first session, which I think will really set the stage to understand what has been happening and to try to at least flash the light on some of these important topics. And I just want to say, first of all, I'm super excited to have people from the group that has, for example, working at the data on the New York Fed, which has been so instrumental in documenting, for example, the increase in debt. And without that data, I really don't think we would have been able to understand so much of what we see now. And also, very excited to have also somebody who is such an expert on the legal side. The bankruptcy law of 2005 is very important as we start thinking about increasing debt, potentially increasing bankruptcy among the older population, which I think a lot of study has documented. Bankruptcy has more or less, according to some of the data, either double or triple. And so it's very important to understand what is going on. And I think it's very important to look at this with micro data, because I think we need to understand the heterogeneity. Those averages, I think, really hide a lot of difficulties, a lot of differences. For example, perhaps on the older group, but the rich group might be doing very differently than, for example, the lower income group. And one of the important group also of the elderly are women. And this is why we are also so excited to have a presentation that looks at the health retirement study, as in the paper of Karen that we will see in a moment, that also looks at these different groups, and also looks at so much has changed during this time. People are having not defined contribution by defined benefits. It's much more easier to borrow. So we need to understand all of those different groups. And to really put a perspective on this, we have even brought in somebody from Japan, because here is an economy where aging has been, of course, happening at a faster rate, and we want to understand, perhaps we are moving in that direction, and I'm very, very grateful to Charles from coming all the way from Japan to actually tell us what's happening, what has been happening in Japan, and actually put that perspective on understanding that in the US. So without further ado, I'm going to start with Meta, and I am going to sit here and try to give you all of the warning, because one of the things that I have learned is that people do not deliver on time and tend to speak too much.
Thank you, Anna Maria. I promised to need the warnings. Thank you. Let's see. I'm going to try the clicker. Sorry. Alrighty. Hi. Thank you so much to the organizers. It is quite a privilege to be included in this program. I'm so pleased to be here today, and very much looking forward to all that we'll learn together. This project is a collaboration with my Fed co-authors, Dong-Hoon, Joel, and Wilbert. Dong-Hoon and Wilbert in the room here can answer all of your questions. And this is a phenomenon in the data that we've been observing over a number of years and calling among ourselves the graying of American debt. And so this talk is very much in the line of documenting patterns that are emerging, so very descriptive work. I'd like to come at this talk by just showing you a series of charts. First, I'll describe my data to you very briefly, so hopefully you agree with us regarding the credibility of our two sources, and then just look at a number of charts on debt and repayment by age in our sources. Having said New York Fed, you're going to be wondering, Meta, will these be the opinions of the New York Fed and the Federal Reserve System? I have to tell you, not necessarily. Not necessarily. So our two sources for this series of charts are the New York Fed Consumer Credit Panel, which I will from now call CCP. This is an ongoing collaboration between the New York Fed and the Equifax Credit Bureau. It's a 5% representative sample of credit reports every quarter from 99 to, as you can see, very recently. Sometimes we subsample to a 1 or a 0.1%, but a very large data set to give some precise measures of the patterns we're looking at. And these are information, obviously, on the lender side, so what lenders are reporting regarding older borrowers' borrowing amounts and repayment practices. We'd also like to enrich our picture a bit with the Survey of Consumer Finances from the Federal Reserve Board to tell us something about what borrowers say they're doing in terms of debt and repayment. And I should note that there are greater experts on the SCF in the room than me, so I'll be brief. This is a representative survey of US households. So of course it's smaller than 5% US. It's 6,000 in some households in 2016. But it's a much richer picture of what the households are doing. It's their description of assets, debts, and many other details that we like to bring into our story where we can. Okay, so let's start by just getting into the data. Here is a chart of the US aggregate debt by single year of age in the Consumer Credit Panel for, in the blue, 2003, and in the red, 2017. And what's noteworthy here, probably immediately obviously, is that the blue and the red are almost coincident for younger ages. So for the teens, 20s, 30s, maybe even they're quite close through the 40s. We see very similar debt in real terms in 2003 and 2017. But as we move into the older ages, the 50-somethings, 60-somethings, 70-somethings, and beyond, the red line departs from the blue. We're seeing substantially more debt at each single year of age through the near retirement ages, and so on. And so to put a number on it, what we're observing is in real terms an 87% increase in the aggregate debt in the hands of American borrowers ages 55 to 80 from 2003 to 2017. So this is a substantial change in borrowing in near retirement ages, which might immediately lead you to wonder, well, what sorts of debt are our retired, near retirement consumers taking on? So this next chart is just a simple histogram of debt per capita among our 65 plus CCP sample members, but census denominated, so per capita debt among older Americans. At your left, 2003, in the middle, 2007, and at the right, 2017. So you can see the steep rise in per capita debt here from $20,000 to about $30,000 to about $38,000 of debt per capita for our 65-year-old and older American consumers. And the color segments divide this debt into different traditional debt types. So we can see in the yellow an 89% real increase in mortgage debt per capita among those 65 plus. In the orange, we see about a 69% increase in real auto debt among older Americans. The gray is credit card debt. It's up a bit. You can see a blue line emerge by 2017. There's really little evidence of blue in the 2003, but by 2017, our older borrowers are, in fact, holding meaningful student debt per capita. So that's about $727 of student debt per capita among Americans ages 65 and above, which surprised me. So they have participated in the student loan wave that characterized the period. And just to underscore that this is not a widespread phenomenon, all of our consumers borrowing more of all types of debt, let's take a quick look at the 18 to 34-year-olds and note that the picture here is, forgive me flipping back and forth, quite different. So that in 2003, in real per capita terms, we saw 18 to 34-year-old borrowers holding, on average, 150% of the debt that we saw 65-plus-year-olds holding, which might comport with it fits our notion of the life cycle consumption saving behavior that we've long talked about. But then we get to 2017, and we see our younger borrowers holding, in a per capita real sense, about 81% of the debt of our 65-plus borrowers. So now we have substantially more debt per capita in the hands of retirement age consumers, even than the sort of young working households in the 18 to 34 group, which is a substantial remaking of the patterns of debt that we see in the broader economy. So one might ask, well, how did we get here? In a descriptive sense, how did we get to this place in which older borrowers hold substantially more debt per capita than our young working borrowers? If we think about two possibilities, one is that the slowdown in new lending that we observed from 2009 forward means the current stock of outstanding loans is sort of an older vintage on average, and the associated borrowers of an older vintage on average, as I increasingly am too. And another perspective, another possibility is that perhaps new originations are just increasingly going to older borrowers over younger borrowers in the more recent years. And so we take a look at originations in the CCP data to think about the contributions of these two factors to the shift of debt into the hands of older borrowers from 2003 to 2017. If you look at the table here, there's more detail in the paper, but just take a glimpse of the originations. Mortgages originated per capita to the 18 to 34-year-old group in the top row have declined from 2004 to 2017 from 0.086 to 0.027, so it's a substantial slowdown in mortgage lending to young borrowers. To older borrowers, 65 plus, we again see evidence of the slowdown we're all familiar with, 0.059 to 0.032, but we also note that the slowdown is not as great for the older borrowers as for the younger. And so there's some combination in the mortgage market of overall slowdown in lending and a tilt away from younger toward older borrowers. And the tilt away from younger to older borrowers is more pronounced in the auto loan industry, where we see the 18 to 34-year-old per capita originations at 0.175 in 2003, 0.132 by 2017, and at the same time, 65-year-old borrowers are actually originating more auto loans. So from 0.090 to 0.10, per capita auto loans originated among the 65-plus set. So we're seeing in the auto sector, particularly, a very pronounced tilt away from younger borrowers toward older borrowers. We see a very similar, surprisingly very similar rate of auto loan origination between the 18 to 34-year-old and the 65-plus set in recent years. Okay, so why then might we see this shifting of originations away from younger to older borrowers? And I just wanted to put up this chart for a moment to allow us all to speculate together a little bit about the supply side of this change. So this chart depicts the median Equifax risk score by single year of age for 6 decennial birth cohorts. Every colored stripe is a birth cohort. And what you see is a steep, pronounced, very consistent across birth cohorts and over 15 years of data, positive association between measured creditworthiness and age. And so if we think of the tightening of underwriting standards that appeared following the financial crisis and that has persisted for a long time now, we look at this chart and we can quickly imagine what age groups at the median are going to be excluded from credit markets following that tightening of underwriting standards, what age groups will remain. And all of this leads at least me to think about how older borrowers are faring with repayment of their increasing bulk of debt or their increasing financial obligations over the period. So we have a couple of pictures, one from what lenders say is happening with repayment in the CCP. The next picture, what borrowers say is happening with repayment from the SCF. So here are the lenders. We've got annual transition to severe delinquency as a percent of balance on the horizontal by age, and the three stripes describe 3 different waves of the CCP: the blue, earlier, 2003, the orange, 2007, and the gray, 2017. And what you see is both a steep decline with age in the rate of transition to severe delinquency of outstanding debt, importantly as a percent of balance, both historically and very recently. So in the face of this increasing debt burden, our older consumers are persisting in showing very reliable repayments. If you look at the magnitude on the y-axis here, this is very low delinquency in an absolute sense and low relative to younger borrowers. Now that's not to say that we're not concerned about delinquency in this older age group as the bulk of debt that they're carrying increases. Because of course, if we have a constant rate of transition into delinquency and a much larger amount of debt, we're going to see more, in an absolute sense, debt dollars in delinquency that our older households are struggling with. And it's just to say that somehow in the face of all of this, the percentage of debt being repaid successfully is surprisingly consistent. And we see something, just quickly glance at the SCF to say when you ask borrowers, they say something similar. So our delinquency measures here for 5 different waves of the SCF, again, steeply decline with age. But the next thing to say about this chart is that it also suggests a stable over time, low delinquency rate for our older borrowers, and yet does not rule out, and actually would suggest a large, thank you, Anna Maria, increasing bulk of debt in delinquency as the debt of older borrowers outstanding increases. Let's go for time. So all of these have been sort of aggregate measures in age groups so far in the CCP and the SCF. A lot of what we might be interested in with this question is heterogeneity in the experience of debt and repayment by economic circumstances, with economic circumstances. And we've taken a look at this both in the CCP by zip code income and in the SCF, dividing our households by asset level, so looking across the asset distribution. I'm showing you SCF quickly because I find it easier to explain briefly, but you'll see that qualitatively what we're finding in the CCP is quite similar. So this is just a couple of quick pictures on heterogeneity in debt experiences by assets from the SCF. In this chart across the horizontal, we have the asset decile of the SCF household, going from 1 at your left to the top, the highest asset decile, 10 at your right. Each dot indicates the average within the decile amount of household debt. Green dots, 2001, blue dots, 2016. And what emerges from this picture is that in terms of the bulk of dollars of debt increased from 2001 to 2016, the lion's share is coming from our more affluent households. So the top 2 asset deciles are showing a 70,000 at the 9th decile and 83,000 at the 10th decile dollar increase in mean debt within the asset decile, where our lower asset borrowers, their increases are comparatively tiny in dollar terms. Throughout the middle of the distribution, I'll just mention, we do see meaningful increases in the dollars of debt per capita to the tune of $20,000, $30,000, $40,000 in that middle decile range. That is largely attributable to increases in primary residence debt that are being carried near and into retirement, which of course has all of the accompanying implications for financial security in retirement. And then last thing that I'll say about this and then wrap it up, here's a picture. There are other measures, of course, that you might care about if what you're interested in is not just where these new dollars of debt among the old are coming from, but financial security and the challenge of dealing with these financial obligations. So let's look at one. Here is a ratio of debt to assets measured across the asset distribution. Again, green for 2001, blue for 2016. And here, in great contrast to the dollar amount growth in the first picture, we see that the debt to asset ratio increase belongs largely to the low end of the asset distribution. So where our high asset households have almost no increase in debt to asset ratio observed in these data over the period, at the low end of the asset distribution, particularly if you look at the first decile, we see an increase of total debts within the decile divided by total assets within the decile from 0.33 in 2001 to 1.02 in 2016. And a lot of this is coming from the surprising extent of participation among first asset decile households in the student loan wave. So older first asset decile households have substantial student loans, in fact. And then again, increases in the debt-to-asset ratio for the middle of the income distribution, largely tied to that primary residence. So to conclude, real debt held by US borrowers ages 55 to 80 has increased by 87% since 2003. Meanwhile, per capita debt among the young has declined or been flat, depending on your measure. Much of the growth is attributable to housing debt. We're seeing, you can see in the paper, about a fifth of the per capita housing debt growth appears to be coming from non-primary residences, second and vacation homes, and more than half from increased mortgage borrowing among those higher asset households we talked about. This circumstance appears to have arisen through a broad slowdown in lending alongside a tilting of new originations away from young borrowers toward old. A repayment among older borrowers was reliable in the past in percentage terms, and despite this growth of debt in percentage terms, it remains reliable. Sorry, today, that's my time. Much of the dollar amount of growth in debt among retirees comes from the wealthy. Low to moderate asset households have seen meaningful increases in debt to assets coming from primary residence and student loan debt.